Welcome to our series on Warren Buffett's 4 rules. As discussed previously, we are going over the 4 different rules that Warren Buffett has for choosing stocks to invest in, and this episode, of course, is episode number 1. The first of his 4 rules is a business that you can understand, and for Warren Buffett, that meant a lot of insurance and bank stocks, and also traditional stores such as candy and furniture. Now, obviously, if you're trying to know how a business works, you have to know how they make money. When knowing how they make money, I feel like it comes into 2 main parts. The first part is, of course, the actual cash exchange. So, do they sell products or give services? And if they are selling products, what products are they selling? If they're giving services, then of course it's the same deal. What services are they giving? Some companies even do a combination of both. Then, who is the person or people that is buying the products or services? And do you know why they are buying this? Are they necessary or a convenience for people, perhaps even just entertainment? Then the second part is the advantages and disadvantages of your company. Who are the competitors? And why is this company better than the competitors? Which is a moat, which is in a previous video that I did explaining how to identify the advantages and disadvantages of different companies. And then also, how regulated is this business? Part 2 of investing in a business that you can understand is the stable and reliable growth. You want to predict future growth rates and estimate intrinsic value. If your growth looks like an EKG, then it's very difficult to do that because making predictions is more of speculation than it is actual investment grade. It's worth noting that for stable and reliable growth, we are not talking about the stock's price. That's a choice of Mr. Market, which is a concept by Benjamin Graham, which is a topic that was previously discussed on the channel as well. For stable and reliable growth, Warren Buffett is talking about the growth of the business. So for an example of stable and reliable growth, we're going to use Tractor Supply Company as an example. And we're going to start off by just looking at the stock chart and seeing what it shows us. This is a 5-year graph, and as we can see, it managed to fall all the way down to $51.06 in early July 2017, but managed to rebound years later. But, however, if we look at the entire 5-year performance, it appears to have primarily just been going sideways for the 5-year growth, and the price chart alone is not an indicator of the reliability and growth of the company. It appears to have been really just going nowhere. However, if we look at the company's financials, we can look at the revenue, which as we see here is pretty stable and reliable. It's fairly predictable as to where it's going to be 10 years from now. And the same thing with the gross profit. It's also following similar trends. For our gross margin, we can see here that in the financial crisis, there was a bit of instability, but not too bad. It only managed to drop to just barely above 30%, and then it managed to climb a couple years afterwards. And it's been steadily growing and increasing the margins as the company's been growing, which is fantastic. So that was an example of the revenue and gross profit, but what about the actual shareholder equity? As we can see with shareholder equity, it's also fairly reliable. It's not as clean as the previous numbers, but it's pretty good. And it's also going up and to the right for the shareholders. Of course, if you're investing in any company, understanding the debt, obligation, and burden that the company is going to be dealing with is very important. So we see with Tractor Supply Company that it is steadily and gradually going up and to the right for many, many years. However, in recent years, it appears to have spiked for some reason. So I didn't look into this myself personally as to why they did this or what they're purchasing with the debt. However, if this was a company that you were interested in and that you wanted to invest in, understanding where that debt money is going to and what they're trying to fund and make for the future growth of the business is obviously very important for whether or not you understand the business and what it's trying to accomplish. And of course, assets is another side of the coin. Obviously, there's the debt. But the debt isn't just there for no reason. It's there to purchase something or make use of that cash in some way. So it looks like Tractor Supply Company, in some manner, purchased many assets in the recent years with that debt. So the question is which assets they purchased and whether or not you feel that the purchase of those assets are more or less beneficial to the company than just ignoring the debt altogether. And that comes with understanding the business and knowing whether or not it is actually a good purchase. And that is part 1 of Warren Buffett's 4 rules, being a business that you can understand. If you're new here, subscribe and hit the bell for notifications to get updates on this series and other series that I'll be doing in the future. And if you enjoyed the episode, leaving a like so that others can see it is greatly appreciated. Thank you so much for watching, and I hope to see you in the other episodes.